In a system that just ain't right, gonna tear it down, gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules, I won't comply. Anarchy's the way. It's time to fly. I'll burn down the walls and break the
And here we go. Welcome, I'm Matt. This is the Anarchist Investor coming at you live every Monday through Friday at 12 Eastern, talking about contrarian investment, markets, the economy, how to protect and grow your money without getting it stolen by some dirty banksters. All right, what are we looking at today? Today is an interesting one. So the trends are just kind of continuing in the casino as well as in the crypto space. And so there's not like huge tectonic shifts happening, but we'll cover the markets. But really what I've been looking at recently is just kind of the underlying mechanics here. And so we've talked about some of the other, the dollar drain that's happening and the fact that we're actually nearing a liquidity crisis if we're not already in one. And so that's a dynamic that's playing out here. What's also interesting is we have another dynamic that has to do with why the stock market, aka the casino, does not accurately reflect what the underlying economy is doing. Okay. Ideally, the investments in companies and entities that are doing business within the economy should reflect in some way, shape, or form how the economy is actually performing, growing, contracting, stagnating, right? But what we come to find out is that there's a multitude of reasons why that doesn't line up. Okay, and so we're going to talk about a big one today, and it's one it's been controversial in the past, and then it just basically died on the vine when other things came up, politics and news stories. And I can remember as far back as like the early 2000s, people were talking about stock buybacks, which is what we're going to be focused on, and whether or not they were actually good for investors, good for the economy, good for the stock market, et cetera, et cetera, et cetera. All right. A reminder, help me out with the algo. Definitely give me a subscribe, a like, a thumbs up. The YouTube channel is brand new, so please help me out there. Throw some subscribes my way, even if that's not your preferred platform to watch or listen on. And a reminder, if you're listening to the recorded audio version of this on your favorite podcatcher, please give me a review. Like a thumbs up or a 5-star on those platforms will help a lot to get this message out to a lot more people. So on the hold screen, I had Bitcoin. We're watching Bitcoin today, just because I don't really have a good real-time ticker for stock buybacks or anything like that. I mean, I guess I could have pulled up a single individual stock or something for y'all to look at. But what I do want to share that is germane to this conversation, good word right there, is a story that came out of Yahoo Finance. And I believe this came out, is this today? Came out in the 8th, so it came out yesterday. And it says, stock buybacks hit highest level since 2018. All right. And there's a little chart down here. It basically shows kind of like the history of stock buybacks of S&P 500 companies. And if you've noticed, they've risen dramatically over time. If you also notice, and this is something that's very important from like a economic trends standpoint, typically they hit their peak just before we end up having some kind of economic turmoil. So, July of 2018, they hit a peak. Obviously, I've talked about the Fed trying to put their foot a little bit on the brakes and causing a problem there in the banking sector, which then had to be unwound. And then all of a sudden, COVID comes along and wink, wink, nudge, nudge kind of takes care of the problem in the short term. Back in 2015, there was actually a little bit of if you remember back, the sovereign debt crisis in Europe and Greece, and they're all falling apart and stuff like that, right? And then back here in 2007, in December of 2007, we end up hitting a high in terms of stock buybacks, at least the announced amounts, right? For the most part, typically, and I don't have a chart for this, but I've seen a number of them, when they announce certain amounts of stock buybacks, most of the announced amount usually ends up getting purchased. There's usually a little bit of an amount at the top end that might not get purchased. But I really want to talk about the nature of stock buybacks because these things aren't a lot of people don't really understand them. Okay, if you're like just a regular person in the market, or you're like a layperson that doesn't really geek out on this stuff, okay, stock buybacks are essentially how should I put it? They're sold as returning money to investors because, as you can imagine, a company that takes the cash that they have on their books and buys its own stock back, they have to buy the stock back from someone, right? And so they have to buy the stock back from typically individual investors, large net worth investors, hedge funds, pension funds, et cetera, et cetera. And so those investors are basically giving up their, a couple of shares of stock to get cash from the company. All right. It's essentially a way of liquidating a small portion of your position and realizing the gain on that stock if there is one. Well, that sounds all well and good, right? Like, but as typically is the case, the devil's in the details. Okay. So what really ends up happening is the float, meaning the total amount of shares of stock outstanding in that company shrinks as a result of this buyback. And that causes a certain amount of scarcity. People who are big Bitcoin people who believe in, currency or money that shouldn't really inflate very much or not at all, or maybe even deflate over time, they understand the concept of scarcity. Once something becomes more and more scarce, assuming that the value stays intact or the value proposition stays intact, that thing should become more valuable. And so typically you see stocks that announce progressively higher and higher buybacks, their share prices appreciate. And it's because of scarcity. The total number of shares of that stock of that company are now decreasing because the company is now returning those shares to essentially their, I forget what they call it. It's essentially like they put them in the vault, right? Like, and the company has a vault of shares, and some of them trade on the open market and the rest of them just sit in the vault and they're essentially owned by the company, right? This also has a couple of effects. One is it concentrates ownership of the company. And so when the company goes out and buys shares of stock from individual investors and pension funds and hedge funds, et cetera, mutual funds, those shares are now being returned to the company. And so now the company itself owns more of the entire equity base of the company. Why does that matter? Well, typically when things happen at the company, there has to be votes, right? Like shareholders have to vote. And so if you have less and less voters, and those voters retain a higher percentage of the overall float of the stock outstanding, they get more of a say, essentially, in how the company operates. All right. The other aspect here is that these companies, their earnings get made to look better regardless of what the earnings do, because if you remember, one of the key metrics that a lot of people hone in on, at least the headline metrics in the investment world, is earnings per share. Well, if you think in terms of a fraction, the earnings are on the top, the total number of shares are on the bottom, and when you divide, you end up with your earnings per share. Well, say your earnings stay exactly the same, but you decrease the total share count. So basically, you're making the denominator smaller. It makes that EPS, or that earnings per share number, look a lot better. And you didn't have to do more business. Okay. So there's also another term in Wall Street and finance and things like that. It's also used elsewhere in our lives. It's called window dressing. All right. And so a lot of window dressing happens especially when times start to get difficult. Like I said, when you look at this chart, okay, you see in the lead up to major financial crises, recessions, and the like, you see large ramps in stock buybacks. And why is that? It's because the companies themselves find out that they are having a harder and harder time moving the needle in terms of their earnings. So now what they're going to do is they're basically going to conduct what I would say amounts to fraud, because it's not necessarily fraud from the sense of like they're reporting the wrong numbers, like everything's transparent. But at the end of the day, they're being fraudulent from the standpoint of the stock price could go up and the company could be doing, it could be not growing. It could be stagnating. It could even be falling in reverse. But if they have enough of a cash stockpile, they can buy back enough stock to make the earnings look better than they really are, to entice suckers in who don't understand that dynamic, right? The greater fool theory, right? Can we get someone who's an even greater fool than I am to buy this asset at a higher price than I bought it at, right? Um, so that's really the dynamic. And typically what happens here is you see a large divergence between how the stock is operating and how maybe the underlying company is operating, or how the underlying economy is operating. Now, let's also put this in the context of what I've been telling everyone about in terms of the coming liquidity issues that we're going to have, where we actually, believe it or not, are going to have a shortage of dollars in the system, if not already suffering those problems. The reason why there's a shortage of dollars in the system is because there's a giant sucking sound happening from Washington, D.C. Okay. To continue to essentially transfer wealth, some of it within the country, some of it to send money out to other countries. Okay. Washington, D.C. is running huge deficits. They're borrowing records amounts of money. I mean, they're spending like drunken sailors. And the reason why that's to our detriment is because when you send money to Washington, D.C., and they essentially use that money to transfer to someone else, you're getting a U.S. Treasury. Okay. And that U.S. Treasury is a claim on money, plus you get some interest that's associated with it. So over time, right, the money supply grows because you're giving them $1,000, and in 10 or 30 years, they end up giving you back $1,200, right? Like, or $1,100. So it's a way of stretching out inflation. So you still get inflation, but for the most part, government spending in the short to medium term isn't inflationary. It's essentially just robbing Peter to pay Paul. Okay. It's a transfer, and it's an inefficient one at that, because there's waste involved in it. There's inefficiencies, right? There's bureaucracy, there's fees, there's holdups, and all this other stuff, right? And so what you end up getting is, not to mention the fact that because you're paying interest, you're also stealing demand from the future. Okay. Either in the form of inflation or just in the form of that demand now evaporates. It would have existed in 5 or 10 years, and it's just not going to be there anymore. Right. So you have to go further and further and further out to find demand to pull into the future. Right. It's kind of like leveraging the economic activity that you expect to have in 10 years to benefit today. So then the question you ask is, all right, well, what the hell happens in 10 years? Well, Washington, D.C. says, well, we'll cross that bridge when we come to it. Right. And then they do that indefinitely. But so that being said, there's a giant sucking sound of cash happening from Washington, D.C. All right. This stock buyback situation makes things worse because, like I said, a lot of the shareholders that are getting the cash from these corporations and returning their shares to the corporations, what are they going and doing? Well, a lot of the educated money right now, a lot of the quote unquote smart money, all right, these big pension funds and hedge funds and mutual funds, they're buying US Treasuries because they're becoming more and more risk averse, while everyone else who has to take on more risk because of the inflated prices and because of wages not keeping up with that price appreciation or that cost appreciation. All of those folks are having to take more and more risk in order to make up the stagger. Well, the wealthy don't have to take that much risk, right? All those people that I talked about yesterday that are, in the Milken Institute, that are basically, in Beverly Hills right now, sipping mimosas and, enjoying eggs Benedict, they're earning 4.5% federally tax protected on their US Treasuries, right? And so when they get a ton of money from Apple or Google from a stock buyback, some of that money they're going to redeploy into the market. And then some of that money, they're going to go and just buy US Treasuries and sit on it because shit, 4.5% on $100 million is $4.5 million. That's good money if you can get it, right? And on top of that, it's $4.5 million that you don't have to pay federal capital gains or income tax on, right? So that money is just being further vacuumed into that gigantic sucking sound that's happening in Washington, D.C. Now, This is why, one, the stock market does not reflect the reality of the economy. Okay. The economy can start falling apart in a very big way, and yet the stock market can continue going up because of this shell game that's being played by taking cash and essentially warehousing more and more equity from these companies, reducing the overall ownership of these companies that then gets sucked up by Washington, D.C. and effectively destroyed, or best case scenario, debased over a period of time, right? Now, the mistake is that people think, oh, well, eventually that will make it back into the economy and it will result in growth. But no, because of the waste that's built into that cycle, that's typically not the way it happens. And in fact, usually what the bureaucrats and the feds choose to do is then once we go, I mean, we really haven't been through this period of money, of currency destruction, let me call it, since 1929. All right. I need to repeat that again because this is a very important note. We haven't been in a period of currency destruction like this since 1929. And anyone who has even a moderate understanding of financial history understands how dire 1929 was, or at least what happened following 1929. A lot of people forget what happened in the lead up to the Great Depression because we actually had a double dip essentially. There was like a depression, and then there was another depression right after it. Okay, the Great Depression, I believe by some historical accounts, wasn't as bad as the other depression. All right, but so that being said, since 1929, we haven't had currency destruction like this in this country. All right, um, this is obviously a very bad scenario from the standpoint of in the immediate term, we are facing potential liquidity crisis. And in a liquidity crisis, um, you have dollars that get very valuable because they're being destroyed. And so you have scarcity. Okay. So the same scarcity that's causing the stock prices to go up is also causing an underlying bid for dollars. Okay. Because eventually, and I'll pull this chart up. I gotta find it first. Eventually corporate profits top out, right? And so this is something that I'm watching very vigilantly, okay? Because corporate profits versus stock buybacks is going to be a big determinant of how the casino works moving forward here. And why is my screen not popping up? Here we go. All right. So this is corporate profits. And if you notice, it's up and to the right, to the freaking moon, right? Now, that being said, this is with inventory value adjustment and capital consumption adjustment. Okay. I also have another corporate profit indicator that shows a little bit of a different picture because this is the after tax without some of those adjustments in there. And some of those adjustments are just accounting bullshit. Okay. But if you notice, they peaked in April of 22. Okay. Fell back. And if you notice, October of 22 was when we started to find a bottom after the bloodshed in 22. And since these numbers have moved higher. Now, granted, this is a 3-month delay. So we haven't even gotten the most recent, actually, the most recent figures would be the January numbers, and I believe there's a lag on that because they have to, vet them and see where all these numbers hash out to after all of the adjustments. But that being said, this is what I'm watching because corporate profits, if they top out, and yet the stock market continues to hold its level or maybe even increase, it's because it's nothing but stock buybacks. It's nothing but shell game accounting bullshit. Okay, and really, there's a lot of evidence that this is true because you've seen even companies that should be doing okay right now. Like think of recession, quote unquote proof or at least protected companies. Companies where if you're middle income, you would trade down to. So as opposed to going to like, Applebee's or TGI Fridays or, some of these kind of like middle of the road restaurants, your Friday night might be out at McDonald's, right? Or Wendy's. Well, those companies have already issued warnings that people are buying less. They're either not shopping there, or, they're not buying food there, or when they do buy food there, they're not splurging on extras and drinks and all this other stuff, right? That's a really dire sign. When McDonald's is having a problem with growing its profits into the future, there's issues in the economy. Okay. Well, that kind of paints this picture where this corporate profit number, it might even get a little bit higher. But notice, even if it goes higher, you would have to see a dramatic pop or a dramatic rise in relative strength as far as corporate profits go. All right. Now, they're going to continue to keep the shell game going as long as possible with the buybacks. But you also have to remember, like I said, they pre-bailed out a lot of these companies. There's a lot of cash warehoused on corporate balance sheets. All right. But that only lasts for so long. And in fact, in a higher interest rate environment, it might evaporate like that. Okay. Some companies that aren't highly leveraged, like Apple, like Google, that have huge stockpiles of cash, they're leading the indexes right now because they can still continue to do this and they're not suffering the same pains that say like middle-sized companies or small-sized tech and innovative companies are suffering because the interest rate doesn't matter as much to them. Okay. And their corporate debt is considered like still A tier corporate debt. So they're not borrowing at, huge interest rates. They might even be getting a discount to the marketplace to borrow money because they have this huge cash stockpile. Well, they're using some of this cash stockpile, and even some of them have started giving dividends back out to investors. Okay. Which is mind boggling because that typically happens when a company reaches maturity. And maturity doesn't mean dynamic growth anymore. It typically means you just kind of keep the trend going and just churn out cash for investors. You basically turn into a utility. All right. That's not a growth environment. So these buybacks are going to prop up the stock market and make the casino look a lot more better than the underlying economy. They've already been doing that. All right. And so this is something to keep in mind moving forward. As we move towards this liquidity crisis, it's entirely possible that we get this whipsaw effect. And if I pull up the dollar here, I'll tell you what I mean. This is the dollar chart, okay? And you could see the dollar rally very precipitously, very quickly in a liquidity event because dollars become very valuable, especially because if you want to stay in business, you have to get your hands on dollars to pay debt, all right? Because as soon as you default on your debt, you're done, right? So dollars get really valuable. So you could see the dollar that has shown some strength here recently continue to strengthen, and that might even ramp up. Okay. If you notice, there's kind of like a moving average here on the relative strength for the dollar on the 3 month. We dipped below it thinking we were going to go lower, and all of a sudden we pop back up again. All right. We'll see whether or not it holds this and the relative strength moves higher because you could see a huge move higher in the dollar. That would then be the beginning of the whiplash that happens for investors because you'd see the dollar rise, you'd see the indexes take a very strong leg lower, and then what would happen is we get the Ben Bernanke helicopter, except this time it's the Jerome Powell, whatever the analogy is, okay? Raining money down. You would essentially get huge upticks in eventually in inflation and price increases on top of the ones that we are already still working through because of the supply disruption of 2020 and that money printing, the component of it that actually made it into circulation. Okay. Now, what's also going to happen is we're going to find out whether or not the Federal Reserve can actually create any more velocity of money. And what I anticipate is they won't be able to. So as much as they print and print and print and print and print and print and print to try and fill this liquidity gap, I would think that there's actually going to be a continued sucking sound, and it might continue from Washington D.C. It might also appear in the form of people being extremely conservative, and even if they're only making 2% or 1% interest, they're going to continue to warehouse their cash at banks or in utility stocks. Okay. They're not going to put that money to work generating innovation and new jobs and consumption, which means you'll get inflation, but at the same time, people aren't going to be deploying that cash in the same way. Right. Or you could get this delayed effect. And so the dollar could ramp and then all of a sudden it could crash right afterward. Right. Which is entirely possible. Now, this is in like the most extreme scenario. And again, these things don't happen overnight. So, you could be talking months or maybe even years of dollar strength. You could also be talking a couple of months before the Fed steps in. So you get this big move higher, and then all of a sudden the dollar starts to fall off, fall off, fall off, fall off. And that dollar fall off is going to coincide with a whipsaw in the stock market as well. And so what I would say is if you get some of these big dramatic moves in the stock market one way or the other, okay, you're going to have to be very careful if you have your money in the casino, because typically what will happen is if you're not agile and you don't know what the hell you're doing, okay, you'll sell and then things will go up and then you'll buy and then things will drop and then you'll buy, like then you'll sell, right? Like you don't want to get stuck in that. I would say most people need to get a lot more conservative now before that happens. Okay. It's why I'm such a big advocate in gold and silver. And look at what gold and silver are continuing to do. This is the 3-month chart, but if I show you the daily chart, gold's still continuing to consolidate here. Okay. This is still a pullback consolidation. Might even have another leg lower before it starts to head higher again. Okay. Because dollar strength typically doesn't result in gold strength. People will sell gold to buy dollars. But in the longer time frame, when gold gets cheaper like this, I mean, you'll see the Fed start to step in. And once the Fed starts to step in is when gold hits that next phase, I would call it, in this bull run. And yesterday we went through the math. It looks like gold goes to 2,700, which, by the way, I was doing some back of the napkin math just before I went live. And so silver's seeing a nice bid today too. Okay. Because we've had weak economic numbers, specifically jobs numbers. So everyone's anticipating the Fed's going to step in. Silver is even more inflation sensitive than gold is, at least in a direct sense. And so silver's been rallying, but back to the napkin math, gold and silver ratio still elevated. Okay. Now, if you notice, it's dropping because silver's strong relative to gold, but still at, 82, 83, that's still historically high, right? Pushing out here, okay? It's actually risen over time, but truthfully, if you kind of like look at the midpoint of this, it's anywhere between 70 and 60 is actually where the gold and silver ratio kind of gravitates to, right? Like if you notice gold and silver ratio ramped and then it pulled back, where to pull back to, like 66, right? Back here it ramped, pulled back to 68, 66. Here it ramped, pulled back, and it actually dropped below that level. And there's a whole other market dynamic happening there. But that was basically 2009, 2010, when no one wanted to own anything other than gold. And I'm sorry, silver was trying to corner the market afterward because of all of the inflation everyone expected from the Federal Reserve and Ben Bernanke's money helicopter. Okay. But if you notice, it continues to move back to this kind of like 60, 66 level. Well, if we get back to that level in that ratio, you could be talking $40 to $45 an ounce silver. All right. You're talking basically, what is that? I mean, you're talking like 60, 70% appreciation in silver price. Okay. Again, doesn't necessarily happen overnight, but if it does return to these kind of like, these average places that the ratio tends to move back towards, that's the number you're looking at if gold continues to rise and silver rises faster than gold does. Right. That's all I have as far as stock buybacks. Okay. I think people need to get a lot more conservative because it's a trap, right? Like I wish I had a button here. I do have a Stream Deck. I got to figure out how to use this damn thing. But I wish I had a button with like, the meme or the gif of General Akbar, like it's a trap. They're window dressing. They're making the casino look prettier than it really is, right? They're throwing lipstick on a pig. The future is not as bright as they're trying to make it out to be. Not to mention the fact that there's also historically high ratios that the casino is trading at right now. Could it get higher? Yeah, sure. I've seen a number of people make a case for a blow off top still yet to come within the casino. It's possible. I actually think we've seen it. We just didn't see it like really in the indexes as much because there were so many things that were weak and there was only a handful of things that were strong, right? This is Nvidia on a 3-month chart. That's a pretty big damn green wick on Nvidia. That looks like potentially a blow off top, especially if this thing reverses course and now falls down from here, right? And so you'll see similar things happen. I mean, there's even some companies that were trying to ride the coattails of this AI bubble, like Intel. Dude, this thing has gotten absolutely obliterated, right? Um, I think AMD has the same blow off. Look at that wick at the top of AMD, and now it's putting in a downward looking candle. A lot of these things look like we had the blow off top. You just didn't see it in the indexes because there was only a handful of things to blow off. Everything else was just kind of muddling along or maybe even moving lower. Right. Everyone's also been expecting this quote unquote great rotation out of these like magnificent seven technology stocks into everything else. It's not really materializing. Right. The Russell should have been just going to the moon right here, and it's not. All right. Now, again, things could change. Fed could step in. All of a sudden, you could see small cap stocks come in vogue again. All right. But that's only if you get actual growth out of it. If the Fed comes in and starts to print money and nothing happens, watch out. Right. That's the whiplash. Dollar up, dollar down, maybe even dollar back up again. Okay. Once everyone figures out what the hell's going on. That's part of the reason why you have to be slow, steady. You don't FOMO into things. You don't completely jump out of things. You have to have an actual thesis and you have to work through it. And you have to figure out, is something overvalued, undervalued? Do I think it's, approximately like valued where it should be? Okay. You have to have these concepts when you're actually being an investor, as opposed to someone who's just throwing darts at a dartboard, right? We haven't seen the rotation in the small caps. I think a lot of people are still waiting for it, but it just hasn't materialized, right? We did see a little bit of a bounce off the lows along with everything else, but again, that just coincided with still a handful of stocks, right? What else am I looking at in terms of? Let me first of all get off this longer term chart, okay? Uh, what else am I looking at in terms of the casino? Volatility it ramped up and then got absolutely destroyed. Okay. Again, we had rate cut expectations; those got dashed. Okay, and so we had a ramp up in volatility because rate cut expectations got dashed. And then all of a sudden, we're like, oh, the economic numbers are starting to suck. That means we're going to get rate cuts again. So now volatility gets absolutely destroyed, which means everyone expects things to continue on to be hunky dory. Volatility can get even lower. I said this way in the past. I mean, the volatility index is at 13. Typically, when you get a blow off top, you get something that's like, over 40. That kind of gives you that blow off top in volatility. Going back here to like 2020, we got really high. I mean, the volatility index hit damn near 80, right? But typically, you're looking for like a 30 to a 40. Okay. Back in 2000, I can't go back on the daily chart that far, but back in 2008, you were up in that 80, 100 range, right? But 40 is usually where you at least have to get to in order to get appreciable turnaround. This last ramp has been nothing, right? It's been a blip. There will be a day of reckoning with this. I would never trade this in a million years. I've tried in the past. It just, you want to talk about ridiculous moves? I mean, the volatility index is the epitome of ridiculous moves. It's probably even more chaotic than Bitcoin is. So I would not try and trade that. There is a day of reckoning coming, though, where this volatility index will break out to a huge level. All right. Crude oil. Crude continues to get a little bit of a bid here. It's bouncing after this big move lower. But again, this could simply just be profit taking from people that shorted near the top, and now they're taking profit down here once this big move happens. If you notice, we have some of these kind of like diagonal resistance lines that are sitting right around in this area. And so it could come up here and reapproach, $80, $81 a barrel. And then we see what it's made of. It could completely reverse course, especially if we continue to get poor economic data, because that means the demand for energy is not going to be going up. And worst case will actually be decreasing, especially if we get tons of bankruptcies in corporate America. What else do we got? Lumber continues to be weak. I already covered gold and silver. Aluminum is actually coming back down to earth a little bit after the tariff talk and everything like that. But we'll see what happens with that moving forward. I think a lot depends on whether or not the presidential candidates continue to beat that drum. Okay. Palladium's catching a little bit of a bid today, but again, over time, it's still continuing to be weak. Uranium's down a little bit today. And again, it's in this little bit of a price correction, but the URA ETF still remains above this kind of like, I drew kind of like this line of best fit for the ETF. It continues to move in this upward fashion. I'm actually in the process of trying to set up an interview with Lobo Tigre, who is essentially, I believe his nickname is Louis J. And he's big on gold, big on uranium. He runs, I believe it's called the Independent Speculator, the newsletter. And I'm going to be interviewing him. So look out for that at a later date. I also have later today, I will be recording the interview but I will probably not release it until next week with Patrick Smith over at Anarchist. We're going to be talking about Roger Ver and that arrest and those, those charges against him in terms of tax evasion or fraud or whatever, along with all the other trumped up BS that comes with it. But we're also going to be talking about crypto, Bitcoin, Bitcoin Cash, the state of the market, that kind of thing. So definitely check that out as well. Another good reason to subscribe on any of the video or podcaster platforms that I put this content out on. Oh, and a reminder, I'm going to be giving away 4 annual paid memberships on the Anarchist Investor newsletter. So definitely hit up anarchistinvestor.substack.com. If you are not currently subscribed to the newsletter, you can subscribe for free, and that gets you in on the drawing for those 4 paid memberships. They're worth 100 bones a piece, which means they end up being basically a $400 giveaway this month, and that will be done live on this program June 3rd. So make sure you're subscribed to be in on that action. All right, that's pretty much, let's look at fixed income really quickly. I mean, that's really all I saw with the casino today. Looking at high yield bonds, they're down slightly today, but again, they're still in this kind of like hovering pattern just below this resistance line. So we'll see what happens with them moving forward. This for me is a neutral indicator. It's not saying up or down. Once this starts to move appreciably in one direction, then you have some kind of idea where it's going to go. And then we have to ask ourselves whether or not there's some staying power there and if it's going to continue on. Now, what is interesting with US Treasuries is investors are buying the short end and they're doing a little bit of selling on the long end. And this typically points to an attempt to de-invert the yield curve, okay, in anticipation of lower rates on the shorter term US Treasuries, meaning the anticipation of Federal Reserve rate cuts. So that means that, let's see, our inversion between the 2-year and the 10-year here is basically 3.33. Used to be 0.4 as recently as a couple weeks ago. So we're beginning to close that gap. That's turning into potentially a de-inversion of the curve. And usually chaos happens right after that happens. All right. So again, something to keep an eye on moving forward. All right, let's get out of the casino. Let's look at some crypto really quickly before we wrap up. Bitcoin's catching a little bit of a bid today. There's been some back and forth here with Bitcoin. I'm still very much so of the mindset that I think Bitcoin has to pull back a little bit before we see the next really big rally here. I mean, it's entirely possible. I put in a price target of like 54,000 for that pullback. It's entirely possible that this pullback that we had recently to 56 is all we're going to get. That being said, I'm going to talk to Patrick later today just about the state of Bitcoin in the marketplace, because there's so much happening right now that is kind of like not supposed to be happening. To put it lightly, like there's a lot that's happening in the Bitcoin universe that really shouldn't be happening, because Bitcoin was never intended to be in this kind of territory, right? Like, yeah, there was going to be some value increases anticipated, but it was anticipated that the coin itself be used as transactional currency, then a transition to a store of value. Now, and you'll hear it from Patrick later on today, I don't want to steal too much of his thunder, but he thinks of Bitcoin as outmoded technology, right? That there's better stuff up and coming. I would tend to agree with him to a certain extent. I actually think Bitcoin is more akin to one of the first versions of digital art. I think you might actually end up seeing, because of the transaction fees and the value and everything like that, Bitcoin might end up being like a standalone NFT, just Bitcoin itself, right? And you'll have historical value to say that, like, I hold, this proportionate share of Satoshi Nakamoto's original Bitcoin. And that'll be it. Like, it'll have sentimental value, historical value. You might be able to trade it to someone for more money, but it'll essentially be a collector's piece. And the question is, what value does that have? Well, I mean, that will fluctuate kind of the way that ownership and value of a Monet or a Rembrandt fluctuates. Okay, moving forward, we'll see what happens with it, but that's really my take on it. Ultimately, I think that there needs to be a shakeout because there's a ton of people who think Bitcoin is something that it isn't. And so they're going to continue to, put money to work until they feel like they're not getting out of it what they originally expected. And then you'll see a flush out. And then we'll see what it's really made out of. I think we have yet to see that flush out. And that flush out looks like maybe 54,000, could even go lower down to 46,000 before we eventually get that turnaround. And then the Fed, quote unquote, rescue will reinvigorate the Bitcoin trade. And then you'll see that 90 or 100K in Bitcoin. And then that might be it. I don't know. We'll have to find out. I mean, that's way down the line though. So we'll have to talk about that when we get there. The overall market cap for crypto today is up like 1.8 and Bitcoin's up 2%. So that means that the rest of the rest of the crypto marketplace is basically mixed. It's like netting out to no gain to even a slight loss, whereas Bitcoin is up and outperforming slightly right now. All right. Again, this isn't really a material change in the direction of Bitcoin just yet. It's just a bounce in the near term. So we'll have to see what it does. I mean, as you zoom out on the chart, again, we're still looking at this kind of pullback from the all-time high. And the question becomes, is this a bull flag that eventually plays out into that run to 90 or 100K? Or is this, the beginning of a turnaround that then sees lower prices in Bitcoin before it finally moves higher? I don't know. Could be prolonged too. I mean, it could just be this really long bull flag that gets us to that 56 or 55,000 level. So we'll have to see how that works out. Bitcoin Cash is flat. A lot of other names are slightly up, slightly down. Solana here. Solana, again, has pulled back from this really big ramp that it had back earlier this year. And so that's pulling back. Again, I actually did I don't have the box with me. Earlier today on the newsletter, I did a walkthrough, very short walkthrough and review of, I installed a SoarChain mini miner, previously known as the Modus mini miner, on my car. And so I'm going to be utilizing that to monetize my driving data. And so there's a walkthrough on that, which means that, we're entering an age where the data that you create, you should be able to not only own, but also be able to monetize it. All right. The age that we're coming out of is the age where big titans like Google and Microsoft and Apple and Nvidia, they all aggregate the data that you created. Facebook, they aggregate all of the data that you created. That's your data, but they own it and they monetize it and they make money off of it. They'll tell you that, well, we created the platform, and so that's what gives us the right to it. But we're entering a world where you don't need a titan to create a platform. The platform could be completely decentralized or open source. It could also be centralized, and you could have a handful of people that create it, and they benefit off of it, but they don't benefit by monetizing your data. They benefit purely by creating a platform that allows that data to reward you, and then allows that data to be used by others to then create applications and use cases further and further down the line. So that is my foray into passive mining. I've already been passive mining IoT. I've been passive mining mobile with my cell phone through the Helium network. And so this is another step in that direction. It's actually one of 3 miners that I will be putting into the car in order to monetize that driving data. So we'll see. Further reviews to follow, as well as the SoarChain miner SoarChain is still in its testnet phase. So it doesn't even really have a value yet. Hasn't begun trading on an exchange. So we'll see what that value looks like. Who knows? Maybe it'll be like worth $1,000 a token the first day, and I'll just fucking liquidate. I'll be out. I'm done. See you later. But no, not realistically. I mean, it'll be something that's a slow as you go kind of thing, but it will allow me at least to build some kind of base of crypto and take some of it and reinvest in other areas as well within the portfolio. So, all right, what else am I looking at crypto wise? That's really it for the day. I mean, some of the other micro cap coins are up and down. Again, I mentioned mobile. Mobile's been hit recently. It's, it ramped once it went live and then it's pulled back again. What is this made of? We don't know. I mean, we're still talking about just a couple of months of pricing data. So, what does the next 5-10 years look like in this project? We'll see. We hopefully it's wildly profitable and popular and becomes utilized by a lot of different platforms, or at least a lot of different people for their cellular data. Same thing with IoT. Same thing with, Sorchain, or the other miner that I have coming is Dimo, DIMO. So we'll see how that works. And also the Honey miner I'll have that's going to help with roadway imaging as well as GPS and all kinds of other stuff. So should be fun. All right. With that, that's all I have for today. So a reminder, help me out with the algo, sub, like, share, give me a comment. Let me know what you're looking at. I want to hear what you're looking at, whether or not you think I'm full of shit or whether or not you think I'm right on the mark as far as what I'm looking at and how I'm interpreting things within the marketplace. So with that, everyone, I appreciate your time, your energy, your love, and your attention. And with that, I will be back tomorrow to round out the week. It'll be a happy Friday. I'll be here at noon Eastern live. So I'll check you then. Ready? Peace.
Stuck in a system that just ain't right. Gonna tear it down. Gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules. I won't comply. Anarchy's the way. It's time to fly. I burn down the walls and break the chains, shatter the illusions, expose their games. The stock market's a stage. I'll steal the show with my rebellious spirit. Watch me grow. Burn down the walls and break the chains, shatter the illusions, expose their games. The stock market's a stage. I'll steal the show with my rebellious spirit. Watch me grow.